Welcome to Cruise News, your daily update on everything happening at sea. Visit cruisenews.io to see today's stories and sign up for email alerts.
Thank you for joining us.
Today is Monday, August 3, 2026. And right now, across the industry, cruise ships are sailing so full that some major lines are actually reporting capacities well over 100%.
Right, the operators are effectively scrambling to find new places to put you.
Exactly. So today we're looking at what happens when traditional vacations simply max out. We'll be covering everything from a multi-billion-dollar financial boom at Royal Caribbean to travelers buying permanent condominiums at sea.
Yeah, and even adults-only Caribbean party ships suddenly deploying to the Arctic Circle.
Right. So we begin with the foundational data driving this massive industry expansion, which is the record financial performance and capacity growth at the major operators.
Royal Caribbean Group officially raised its 2026 adjusted earnings outlook, and this follows a second quarter performance that beat their own guidance.
Yeah. To really understand the scale here, let's look at the raw operating metrics. For the quarter, Royal Caribbean carried 2.4 million guests.
Which is a massive volume.
It is. And they achieved this at 110% load factor.
And for those of you tracking capacity, anything over 100% means a significant number of cabins operated with third and fourth guests utilizing the upper berths.
The ships are literally overflowing.
Yeah, they are. And that load factor provides the essential context for the financial returns we are seeing on the balance sheet.
Right. Looking at the bottom line, Royal Caribbean reported second quarter net income attributable to the company of $1.13 billion.
And just to break that down for investors, that translates to $4.2 per diluted share.
But the metric Wall Street pays the closest attention to is the adjusted earnings per share.
Right.
For this most recent quarter, that adjusted figure stood at $4.21.
Which is notable because it easily beat the $3.98 analyst estimate compiled by LSEG.
Yeah, and total revenue for the quarter also demonstrated significant upward momentum. It rose 6% year over year, reaching $4.83 billion.
So that resulted in the company generating an adjusted EBITDA of $1.8 billion.
Just as a quick reminder for you, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right. It's essentially a pure snapshot of the cash the core business is generating.
But when we move to the specific yield and cost metrics, well, the picture gets a little more complex. Net yields increased by 1.9% as reported.
And that yields growth was driven primarily by strong close-in demand.
Yeah, but on the other side of the ledger, gross margin yields actually declined by 5.6% as reported. Furthermore, gross cruise costs per APCD rose by 4.5%.
So let's unpack those acronyms for a second.
Yeah, what exactly are we looking at when we talk about costs per APCD?
Well, APCD stands for Available Passenger Cruise Day. You can think of it as the cruise industry's equivalent to an airline's available seat mile.
Okay, the standard unit of inventory.
Exactly. It represents one passenger capacity on one ship for one day.
Right.
So when gross cruise costs per APCD rise by 4.5%, it means it is costing Royal Caribbean more money to put a passenger on a ship for a day than it did last year.
And that rise in cost is precisely why you are seeing the gross margin yields decline by 5.6%.
Right. Even though the company is generating higher ticket prices through that strong close-in demand, meaning people who book their vacation just a few weeks or months before sailing, paying a premium to get on board, the costs associated with running those ships are rising at a pace that compresses the gross margin.
I want to stop you right there because these cost metrics frame the company's adjustments to its forward-looking statements, and there's an inherent tension here.
How so?
Well, based on these second quarter results, Royal Caribbean raised its full year 2026 adjusted earnings outlook.
Right.
The new projected range is $17.73 to $17.87 per share. That's up from their prior guidance of $17 to $17.few.
Which implies approximately 14% year-over-year growth.
Exactly. However, at the exact same time, the company slightly lowered its full-year revenue growth target.
Yeah, they brought it down to roughly 9%, down from a previous expectation of about 10%.
And they attributed this specific revenue adjustment to prolonged geopolitical activity weighing on bookings for select itineraries.
That's right.
So how exactly is Royal Caribbean managing to raise its earnings per share outlook by a robust 14% while simultaneously lowering its revenue growth target down to 9%?
It's a great question.
Especially when they are absorbing significant inflationary pressures, like specifically a 27% year-over-year spike in fuel costs. The math there just feels contradictory.
It is a critical structural question regarding their financial modeling. It does seem counterintuitive that you could make more profit while bringing in slightly less revenue than expected, all while paying more for fuel. But the answer lies primarily in their pricing power regarding that close-in demand. They are pairing that pricing power with incredibly stringent cost controls in operational areas outside of fuel, alongside very strong performance from their joint ventures.
So even with a lower overall revenue ceiling, because geopolitical tensions mean certain routes simply aren't selling as well.
Right, exactly. The revenue they are capturing on their core Caribbean and North American routes is yielding higher margins at the final transaction point.
And we can see the sheer scale of that fuel pressure in the raw data. In the second quarter, Royal Caribbean used 422,000 metric tons of fuel.
At an average bunker price, net of hedging, of $839 per metric ton.
Yeah, which resulted in a quarterly fuel expense of $355 million.
So to mitigate future volatility, they utilize a hedging strategy.
Right. Currently, 58% of the company's forecasted 2026 fuel consumption is hedged through swaps.
But that coverage is scheduled to decline. It drops to 53% in 2027, goes down to 29% in 2028, and falls to just 14% by 2029.
Can you briefly explain what these swaps actually mean for the company's protection?
Sure. For those following the balance sheet, these swaps act essentially as a corporate insurance policy.
Okay.
The company enters into a financial contract to lock in a set price for fuel over a specific period. If global oil markets suddenly spike due to unforeseen events, Royal Caribbean is protected because they have already guaranteed their price.
So the fact that their hedge coverage drops to 14% by 2029 just indicates that they haven't locked in those future contracts yet.
Exactly, leaving them temporarily more exposed to market fluctuations further down the line.
Maintaining liquidity is also central to how they plan to navigate those future fluctuations. Royal Caribbean ended June with $6.9 billion in liquidity.
And that figure includes cash, cash equivalents, and unused revolving credit capacity.
Yeah. The company returned more than $600 million to shareholders during the second quarter alone.
And from a long-term strategic perspective, management noted that the new earnings per share outlook aligns with their Perfecta program.
Yeah. Right. Which targets a 20% adjusted EPS compound annual growth rate spanning from 2024 to 2027.
Industry leadership remains highly optimistic that they will hit these targets.
Yeah. Jason Liberty, the CEO of Royal Caribbean Group, stated that the company expects, quote, another year of approximately double-digit growth in revenue and earnings.
Furthermore, Naftali Holtz, the chief financial officer, noted that despite the geopolitical impacts dragging on revenue this year, early 2027 booking trends are currently tracking ahead of historical levels.
And to sustain that compound annual growth, their capital expenditure remains incredibly high. It is projected at approximately $4.7 billion for 2026 alone.
That's being driven by the physical expansion of their 71-ship portfolio,
which encompasses Royal Caribbean International, Celebrity Cruises, Silver Sea, and a 50% joint venture interest in TUI Cruises.
Right. And during the second quarter, the company officially took delivery of Legend of the Seas, which is their third Icon-class vessel.
They also have committed financing firmly in place for the newly ordered Icon the 6th and Icon the 7th.
Across the entire group portfolio, overall capacity is expected to increase by 6.6% in 2026.
Which brings us to the next logical phase of this industry evolution. With Royal Caribbean filling its traditional ships to 110% capacity, it is clear that standard vacations are maxing out.
Yeah, and for a certain tier of traveler, the logical next step isn't just taking a longer vacation, it's moving onto the ship permanently.
Exactly. And that brings us to Villa Vie Residences. The company has announced it will unveil its second residential cruise ship, named Legacy, with an anticipated entry into service in early 2029.
This reveal is scheduled to take place during a 2-year sailoversary event for the company's current operating vessel, Odyssey.
And the announcement comes as Odyssey has successfully sold over 85% of its available residences.
Mike Pedersen, the founder of Villa Vie Residences, addressed this expansion, stating, quote, when we launched Odyssey, we set out to prove that residential cruising wasn't just possible, it was sustainable. Legacy is the natural evolution of everything we've learned from our residents and operations around the world.
It represents a significant maturation in the residential cruise model.
Right. While full specifications will be released at the anniversary event, preliminary data indicates that the physical residences aboard Legacy will be roughly 50% larger than comparable units on Odyssey.
Consequently, if you're looking to buy in, Ownership pricing and the monthly maintenance fees for the new vessel are projected to average about 30% above current Odyssey levels.
To provide context for what those increases mean, we really have to look at the specifications of their current sole operating ship.
Right. Odyssey is the former Braemar. It's a vessel built in 1993, operating at 24,344 gross tons and featuring 485 cabins.
And it was acquired from Fred Olsen Cruise Lines.
At this time, it must be noted that Villa Vie has not disclosed whether Legacy will be a second-hand acquisition, similar to Odyssey, or a newly built vessel constructed from the ground up at a shipyard.
Because of that timeline, the company needs a way to bridge the operational gap between now and 2029.
So to do this, they are introducing highly specific sales programs. The foremost is the Legacy Bridge program.
Right, which is strictly limited to 24 prospective buyers who complete new ownership purchases on or before September 30, 2026.
Buyers who participate in this program receive immediate residency aboard Odyssey, followed by a guaranteed right to move into a comparable residence aboard Legacy when it eventually launches.
Crucially, these buyers will lock in the lower Odyssey maintenance rates for their time aboard Legacy, effectively bypassing that anticipated 30% cost increase.
Right, and they will face no additional purchase price for the transition itself.
Additionally, Villa Vie stated that participants in its Endless Horizons program will see their rights carry over to the new vessel.
Endless Horizons was introduced as a $349,999 one-time purchase for lifetime permanent residential cruising.
Yes, and those permanent residency rights will carry across both Odyssey and Legacy without any added upgrade fees or transition costs.
If you are an investor or prospective buyer looking at this, it reveals a fairly complex proposition. Well, purchasing into the Legacy Bridge program requires a substantial leap of faith. The company is asking for a financial commitment of hundreds of thousands of dollars for a ship where the vessel specifications, the builder, and the itinerary program have not yet been released to the public.
Right.
It's the maritime equivalent of buying off-plan real estate before the blueprints are finished.
That is an accurate assessment of the market dynamics at play. But the Bridge program is specifically designed and financially engineered to mitigate this exact buyer hesitation.
Okay, that makes sense.
The company has openly acknowledged that while prospective buyers show high interest in the new ship, they are understandably hesitant to defer nearly 3 years of travel while sitting around waiting for Legacy to begin operating.
Right, nobody wants to just wait on land.
Exactly. So by tying the 24 available Bridge program slots directly to Odyssey's next 24 months of continuous operation, and securing those lower maintenance rates, Villa Vie is offsetting the risk of the unknown vessel.
They're offering immediate discounted access to their proven, currently operating product to keep capital flowing today.
Precisely.
Well, this search for available inventory and the subsequent geographic expansion brings us to our final report.
As traditional warm weather routes experience the sold-out capacity we discussed at the top of the broadcast, premium brands are offering travelers choices in entirely new latitudes.
Right. Virgin Voyages has announced that its vessel, Valiant Lady, will base in Amsterdam for the summer 2028 season.
This deployment represents a 6-sailing program consisting of 4 Northern Europe itineraries and 2 open-jaw repositioning cruises between Barcelona and Amsterdam.
The strategic rationale for this deployment is directly tied to those capacity constraints.
Yeah, Nirmal Severimutu, the CEO of Virgin Voyages, stated plainly that with their 2026 Mediterranean season and their Alaska debut both entirely sold out, quote, Northern Europe felt like the right next step.
For those of you trying to plan your 2028 summer, the itinerary specifics reflect a comprehensive move into Northern European waters,
with every voyage including at least one first-time port call for the company.
The program commences on July 9, 2028, with a 10-night open-jaw sailing from Barcelona to Amsterdam.
And just to clarify, an open-jaw sailing means the cruise begins in one port and ends in a completely different one.
Right. Much like booking a flight into Rome but flying home out of Paris, this repositioning voyage will call at Casablanca, Lisbon, La Coruña, and Cherbourg.
Following its arrival, the first Amsterdam-based departure begins on July 19.
This is a 12-night Scandinavia and Stockholm itinerary, scheduled to visit Oslo, Copenhagen, Gdansk, Stockholm, Berlin, and Aarhus.
Following that, the vessel shifts to a shorter, tighter cadence.
Right. On July 31st, Valiant Lady will depart on a 7-night Norwegian fjords cruise, calling at Molde, Nordfjordeid, Flam, and Bergen.
This is immediately followed on August 7 by a 7-night Scandinavia and Hamburg itinerary featuring visits to Oslo, Copenhagen, and Hamburg.
But the furthest northern reach of the deployment begins on August 14th.
Yeah, this is an 11-night Arctic Circle and Norwegian fjords itinerary. It will depart Amsterdam and call at Tromso, Honningsvåg, Trondheim, Andelsnes, and Olden.
And to mark the occasion, the company has planned a specific midnight sun deck party to coincide with the actual Arctic Circle crossing.
Nathan Rosenberg, the Chief Brand Experience Officer for Virgin Voyages, addressed the varying nature of these new routes, stating, quote, "The fjords called for something calmer. The Baltic cities called for something later. The Arctic Circle called for something we'd never staged before."
Finally, following this Arctic sailing, the vessel will conduct its return open-jaw repositioning cruise on August 25.
Departing Amsterdam for Barcelona, with calls at Cherbourg, La Coruña, Lisbon, and Tangier.
From a logistical standpoint, it must be noted that Virgin Voyages has not yet disclosed which specific Amsterdam berth the Valiant Lady will utilize.
This is an important detail for travelers arranging transportation.
Right. The primary ocean cruise facility is the Passenger Terminal Amsterdam, which is located conveniently on the IJ waterfront near Central Station.
However, the Felis and Cruise Terminal in IJmuiden, which is situated roughly 30 to 40 kilometers west of Amsterdam, is also utilized for some ocean cruise operations and overflow calls.
To maximize revenue on these new northern routes, Virgin is extending its summer season pass product to the Scandinavia itineraries.
Right, this pass allows guests to book the 4 Amsterdam-based northern sailings back-to-back under a single pricing structure.
The listed benefits for pass holders include a central sea terrace cabin, priority boarding, upgraded Wi-Fi, complimentary excursions, and early access to dining.
If we look at historical data, the pass has also included laundry service and specialty coffee credits.
Looking at the historical pricing context, the 2026 Mediterranean Summer Season Pass ranged from $26,000 to $38,000.
And Virgin plans to disclose the 2028 pass pricing on August 14th, 2026.
That is the exact same day bookings officially open for these Scandinavia sailings. But analyzing this deployment poses a critical question regarding brand translation.
What do you mean?
Well, Virgin Voyages has built a very distinct brand identity as an adults-only operator, heavily associated with warm weather environments.
Right, outdoor deck culture and a Caribbean or Mediterranean aesthetic.
Exactly. So the operational challenge here will be adapting that specific onboard energy to the colder and historically more tranquil waters of the Arctic Circle and the Baltic Sea.
Yeah.
It's a bit like a high-energy Las Vegas nightlife brand trying to open a venue in a quiet, historic ski resort.
It is a valid operational concern. But their adaptation strategy appears to rely on shifting the focus away from outdoor pool culture and toward heavily curated, destination-specific events, such as the aforementioned Midnight Sun Deck Party.
Right.
They're also leveraging late-night port departures in the Baltic cities to maintain the brand's nightlife appeal, allowing guests to experience the destination's evening culture without relying strictly on tropical weather conditions on deck.
Right, that makes a lot of sense. So as operators rapidly adapt to sold-out capacities by pushing into permanent residential models in extreme northern latitudes, the definition of a traditional cruise traveler is fracturing into highly distinct specialized markets.
It definitely is.
It invites a larger question for you to consider today. How exactly will traditional port infrastructure keep pace with these highly divergent business models over the next decade?
It's something the industry will definitely have to address.
Thanks for listening to Cruise News. Visit cruisenews.io to catch up on the latest updates and sign up for free email alerts.